Welcome to the Times of Industry Show. I have a phenomenal guest for everyone today. Just a all-around great economic and financial strategist, and it's Dave H. Contrarian on Twitter. David Hunter is with us today for the first time, and I am really excited about this interview, David. So thank you for being here.
Yeah, thanks for having me, Lihar.
Look, I really want to start off with something that you keep repeating in many interviews, and I want to understand where it comes from, and that is that we have been on a bull market since 1982 in the stock market. I know we've been on a bull market for bonds since 1982. Does this correlate with each other? Is this sort of in the same line of thinking? Where does this come from?
Yeah, they're very much linked. Actually, the secular bull market in bonds started in 1981 when rates peaked. T-bills peaked at something over 20%, and Treasury bonds peaked at around 15%, and started their slow trek down that has accelerated in recent years. And the stock market bottomed in August of 1982. And I use that. A lot of people don't understand why I date the secular bull market in stocks from 1982, but I view it as that was really the beginning of the disinflation cycle that's been with us ever since. So inflation peaked out in that period, and we've been trending inflation down towards zero ever since. Ultimately, I think we'll see deflation later this year or early next. It'll be the first deflation cycle since the 1930s. So I think the real bull market in stocks was driven by the fact that inflation and interest rates trended down for 40 years or almost 40 years, and drove price earnings multiples up during that period. So you had cyclical bull and bear markets within that secular bull, but really that was the beginning of the whole move in stocks based on both multiples, PE multiples expanding, and earnings doing better in a disinflationary environment.
I completely understand that. And so let me ask you this. So we've seen bonds go down and interest rates go down and inflation goes down for 40 years. Is this a cycle? Meaning on the other hand of it, are we going to see higher rates and higher inflation, or is this the end of what a lot of people are saying? Hey, the next phase here is not a new cycle. The next phase is something brand new. There's going to be some sort of a debt restructuring from governments. There's going to be some sort of a currency devaluation from governments, and then we'll see what happens. But this is the end of an era.
Yeah, I'm not in that camp. I think there's another cycle to go before we get to anything like that. But yeah, basically, this is a secular bull market in bonds that started in 1981. I think it ends in negative interest rates. And certainly zero, if not negative, here in the U.S. And basically ends in negative inflation, which means deflation. So I think you always overshoot. You have a cycle that goes from very high inflation and high interest rates to a period where you're basically have overshot and now or have the exact opposite problem, which is deflation and negative interest rates. I think we're at the very end of that 40-year secular bull market in bonds and in inflation, or in bear market inflation, I guess. But I think it ends probably in 2021 when we get what I call the second stage of a global deflationary bust. I think we're in that first phase of the bust because of what happened with the virus starting in March. I think we recover for a couple quarters thanks to the massive money that's been printed. And then we see the second shoe drop on the economy here and abroad. So it's a global bust. That's when the deflation comes in. I think the second phase or stage of the bust will be worse than this first stage. It's when insolvency becomes the real issue. You're going to see a lot of companies that could withstand a few months of being shut down, not be able to sustain that through another downturn. So after a couple quarters of rebound, you go back into deep recession, and it gets exacerbated by a what I call an involuntary debt liquidation cycle, where you can see a lot of bankruptcies and companies and banks going under, et cetera. So that will, I think it will happen very fast. I think it'll be first half of 2021 will be from a market standpoint the nadir, but after you'll see a big response from the central banks and from governments fiscally, and you will pull out of that just like we're pulling out of this first part of the bust. And you'll see a recovery beginning in 2022 that I think ultimately will be an inflation cycle unlike anything we've seen since the 1970s, early 1980s. I think you could retrace all of this inflation decline and interest rate decline in less than a decade. So we're talking about a secular bear market in bonds beginning in probably second half of 2021 or early 2022, where rates will go from 0 or negative all the way back to, on the short end, maybe 20%, and on the long end, maybe back to 15% within this decade. So that'll be a hell of a ride, not a good one for bondholders. And you will see in the stock market, I think the peaks we make, and I am calling for a melt up in the stock market this summer. So the peaks we make in this final blow off in the stock market, I think will stand for decades. So, we are making a secular top in stocks. And I think what follows that will be, you'll have a cyclical rebound in stocks in 2022 through maybe 2028 or 9. But you won't get anywhere near these highs that we see this year. And I think you'll be in a very different environment. It'll be an inflationary environment, which means very different leadership. Those that have made so much money just buying an index fund will find that index funds are not very attractive in the next cycle because you're going to, instead of multiple expansion, you're going to have PE multiple contraction. So what will do well, because of all the money printing, we'll start a commodity cycle, and you'll see the metals, agricultural commodities, industrial commodities, and oil all do very, very well. We haven't had a commodity cycle really since the 1970s and early 80s. So most people on Wall Street and in the investment world today have never really experienced what I think we're going to see over the course of this decade once we get through this bust.
So let's break a lot of these things down because I want to really understand how you get to these predictions. These are really wild predictions.
Yes, they are.
Okay, let's start with something that you say will happen very soon. A melt up, right? A melt up, and you predict S&P 500 going to 4,000 or 4,100, and then what? Peaking off and topping off the 1982 to 2020 bull market. Is this what you're basically saying? Because after that, you're saying the markets will never come back to 4,000 for decades, correct? That's basically what you're saying?
Yes.
And the reasoning behind it is the shift in interest rates?
Yeah, definitely. The reason you won't get back to these levels will be the rising interest rates. Keep in mind, if you have rates down under 1% or down at 0, the PE multiples are the inverse of that. They work inversely to interest rates. So if you have rates go from there into double digits, what's that going to do to PE multiples? It's going to contract them. So even if earnings are okay, they're going to be capitalized at a much lower multiple. So it's going to be very hard when you have interest rates rising to be able to sustain the kind of movement in the stock market to get back to highs. And I'm also following this melt up, looking for a historic bear market that could be as much as 80%. So let's say middle of next year, you're going to be coming out of such a hole, down 80% from the highs, that you can have a great rally. You can double or triple the S&P and still not be anywhere near the highs you reached this summer. So, by the way, you said 4,000, 4,100. I've raised my targets in the last few months, or basically not even raised them. I kind of more fine tuned them because I had always said 4,000 plus, and what I'm saying now is 4,200 to 4,500. So I think that's probably where we're targeted here, between now and the end of the third quarter. That will be a hell of a run, obviously, from here. But I think that's the reason for that is that you are coming to the end of, a huge secular bull market, something that we've probably the biggest in history. Those kind of markets or secular moves tend to end in parabolics. So I think you're going to see that here shortly. As momentum builds in the market, you're going to see a lot of those people that are skeptical and sitting on the sidelines, get FOMO, fear of missing out, get caught up in the momentum of the tape. And that's when I think you'll see this thing day after day just start relentlessly moving up. So, it doesn't have to happen, obviously, but that's my call.
David, in December 2018, the Federal Reserve attempted to raise interest rates and did so a little bit too fast, and corporations just snapped. The market went down by 20% on a small interest rate rise. What sort of a chairman for the Federal Reserve would raise rates substantially? Why would that happen?
Okay, let me just real quick go back to 2018 and say I was probably the biggest critic on the street regarding Jay Powell, and saying he was, not really trained for the job. He was a lawyer and was on the job. It was on the job training at that time. And I understood what they were concerned about. They thought rates were so low, they needed to start getting them back higher. And that was basically a popular narrative on Wall Street. I for a long time was saying it was a wrong narrative, but it was popular. And he kind of listened to that. And so he was, over the prior year, raising rates and pulling money down. And I kept saying that's, the economy's too vulnerable. You're tightening and you don't even realize how tight you are. It's going to lead to, a mistake. And so that culminated in December of 2018, and we had, the big sell-off in the market. So fast forward, and all through 2019, or first half 2019, he still fought it, but he was, beginning to understand he had to loosen up. And then in July of 2019, he started, easing again. And obviously, in March, really got religion and understood this thing required a big infusion of money and lower interest rates. I've been a big fan of Jay Powell since March. I've said many times he did the right thing. He was a fast learner. It took him a while to get there, but since March, I have no criticisms of him. He's doing the right thing. I know there are a lot of critics out there because they think this is going to lead to disaster. And as I say, I forecast, don't moralize. I think this is what's needed right now. I do think it's going to be a problem down the road, but that problem was created over, several decades of overspending and overborrowing. So it's not that I'm a Pollyanna here. It's just that you can't worry about that when you've got an economy on its knees. So he's doing the right things now. He understands the seriousness of this, and he is easing aggressively the way he should. The next cycle, when I talk about rates moving up, one of the things that I think a lot of people, including a lot of pundits, get wrong is they think rates are determined by the Federal Reserve. Rates are determined by the market and by inflation trends, et cetera. So when I say rates are going to go from negative to perhaps high double digits, that's all going to be driven by inflation and an overheated economy. So, the Fed's going to be following along. They're not going to be leading it, and they're going to be forced to tighten as we get farther and farther into that overheated economy, and that's when you're going to see them being part of pushing rates up. But for the first several years of recovery, it's really not the Fed that's in charge; it's the market.
Okay, so now let's talk about the 80% decline prediction for the S&P 500. Where did this come from? This is quite a huge decline for stock prices. I can tell you that if they even fall by 30% or 40%, there will be tons of buyers that will be looking to buy the best companies on the planet. So I want to understand, where is this coming from in terms of these valuations? Who will be selling stocks at such low prices?
Yeah, I will tell you, I had a similar argument for several years. I said when the bust hits, oil will fall to $10. I was saying that when oil was $75. I was saying that when oil was 60 and 50 and 40. And I can tell you, I got a lot of pushback saying oil can never go to $10 because the oil companies won't allow it, because they won't be in business if it goes to $10. That just can't happen. And I said the oil companies won't be in charge. It'll come as a result of the markets and the turmoil in the markets, and it won't be there very long, but it's going there. So it's a very similar argument here. Is you can rationalize where the market should be and what people will do, but the truth is, once you get into a panic market, as we saw in March, it really doesn't matter whether there are some people that think the market's undervalued and are stepping in. There'll be plenty of people looking at the tape and wanting to bail out. So the reason I have an 80% downside target is first and foremost because of the massive derivative exposure on the system. You've got derivatives weren't even a part of our lexicon back in as late as the mid to late 80s, and they've just ramped up to a point now where there are quadrillions of derivatives. Not all of them equity, of course. There's a lot of, probably a lot more fixed income derivatives, but derivatives are leverage, and that combined with the 250 trillion in leverage on the global economy in terms of debt, you've got massive leverage from derivatives and debt that will both hit the economy very hard and also hit capital markets very hard. So it can exacerbate, as we learned in business school, leverage works both ways. On the way up, it enhances and you can enhance your growth. On the way down, though, it really can exacerbate the downside. So that's kind of the plain and simple reason why something that might have been 30, 40, 50% is going to turn into an 80% decline. And there'll be fundamental reason for it, because we're heading into what I call a global deflationary bust. We're in the early stages of that bust, or we're in the starting in March, and we get this reprieve of a couple quarters, and then the second stage of the bust will include, I think, very large amount of involuntary debt liquidation, both here and abroad. I think we'll see some major bank failures, probably not so much in the U.S. because of the cleanup we did in 2008-9, but more in Europe and Asia. But we could have some here too, because the economy is just going to be hit so hard. So there'll be fundamental reason for the market to go down there, but it'll also be driven by the leverage.
Okay, where does all of this leave gold in your book?
I like gold very much right now, and silver, by the way. I believe we're headed for 2,300 on gold and 35 on silver, maybe this quarter, but certainly this year.
Just
I
to
think
just to make
long,
sure, 35 an ounce on silver this year in 2020.
yes, yep, we're at 18 now, and I think we can get to 35 within months. And we're at obviously 1800 on gold, and I think we can get to 2300, and I'm not even sure if that's the high this year. But so I'm obviously very bullish on both. Near term, I do think they will be hit in the deflation, the second stage of the deflationary bust. If the market drops 80%, I think it's going to hit pretty much all assets except for treasuries and cash, and probably the dollar. So I think gold and silver can be hit. I used to think that they were going to get hit to the tune of 50–60% during that, and maybe for silver even more than that, during that 80% bear market, but in stocks. But I now think more likely, you might get a 30–35% pullback in the metals, and then move higher, because when we get this hit to the economy and to the stock market, you're going to have a lot. If we think trillions of dollars coming out of the Fed is a lot now, wait till you see the second stage of the bust. They will be printing money like never, many times what we're doing right now. So I think gold and silver will turn faster than the stock market, will turn up sooner. And my long-term forecasts and targets for the metals, because I see this big inflation cycle beyond the bust, I'm calling for 10,000 plus on gold by the end of the decade, and 300 plus on silver.
David, what do you do on your Twitter? What can people check out there?
I generally have commentary every day. It's all my macro stuff. So I'll talk about gold and silver. I'll talk about bonds. I'll talk about the economy, stock market, and my focus is more U.S. centric, but I do talk about global things as well. And obviously, Twitter limits what you can tweet in any one tweet, but the sum totals, through doing it daily, people can get a pretty good idea of what my what my forecasts are, and what's the basis for them. And then I have a quarterly letter that always went to institutions that I've begun offering to retail that is all macro based.
David Hunter, thank you very much for being on the show.
Appreciate you having me. Thanks, Lior.